What's up everyone, it's Scotty with Money Investing. So in this video, I'm going to break down everything Jerome Powell said during the press conference of the FOMC, and then also break down the summary of economic projections, break down the actual questions that we were looking for, the answers that we were looking for, the 10 questions that we had the guidelines and the framework around which I was expecting some more color around. I'm going to break that down. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time, and the link to our Discord and Patreon is going to be down below. If you're interested in joining us, there's a 16% annual discount that is available if you do decide to join before the end of March. So link's going to be down below. You get access to all the alerts, trade ideas, options alerts, and of course, private videos, lectures, and all the other things as well. So first things first, so Jerome Powell and the Federal Reserve decided to raise rates by 25 basis points. Did not come as a surprise because that's what the market was anticipating. And the most notable change that I think the market clinged on was the fact that we are no longer going to see, quote, ongoing rate increases, but instead, quote, some additional firming in the financial conditions. That was the big change in the statement itself, where they are pivoting a little bit away from ongoing increases to some additional firming. The traditional indexes, he said, are focused too much on rates and equities, and they don't necessarily capture lending activities or lending conditions. And financial conditions seem to have tightened more in the U.S. benchmark indexes than what indexes indicate. And the question for us, though, is how significant will that be? And what would be the extent of it? And what would be the duration of it? In other words, the entire banking crisis, the credit crunch that we're going through, how long is that going to go for, and how severe is that going to be? That's a couple of questions. There's a couple of unknowns that Jerome Powell currently has. He also goes on by further saying, and I quote, "It's too early to say really whether these events have had much of an effect." Adding that credit standards and credit availability will be affected, and the longer the banking crisis continues. And he says, and I quote, "I do think there is still a pathway to a soft landing. I think that pathway still exists, and we're certainly trying to find it," is what he mentioned. So again, with respect to the banking crisis, number one, he mentioned that there is going to be support from the Federal Reserve. There is going to be an investigation launched and run by Vice Chair Bard, and they are going to be the ones kind of leading it, and they're going to find out why it happened, what happened exactly, why it happened, and how to implement proper policies to make sure that it never happens again. And they are a little bit unknown or uncertain as to how severe the banking crisis is going to be, and to how long in terms of duration-wise is it going to go. Jerome Powell also tried to assure Americans that their bank deposits will be kept safe, but stopped short of saying explicitly that even uninsured deposits will be backstopped by the federal officials. He says, and I quote, "What I'm saying is you've seen that we have the tools to protect depositors when there is a threat of serious harm to the economy or the financial system, and we're prepared to use these tools. I think depositors should assume that their deposits are safe." So not explicitly saying that all uninsured deposits are going to be safe, but instead just kind of restoring confidence a little bit, saying that, look, we've got the tools to make sure the depositors are safe, and we will use them if there is a threat or a risk to the financial system or to the economy. Now, when it comes to interest rates, right, they also mentioned that if we need to raise rates higher, we will. He says, and I quote, "I think for now, though, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy. Of course, we will eventually get to tight enough policy to bring inflation back down to 2%. And the big nail in the coffin for the markets was the fact that market is getting it wrong if it expects rate cuts later this year. He says, and I quote, "In that most likely case, if that happens, participants don't see rate cuts this year. That's not in our base case assumption." And even towards the end, he mentioned that we're not expecting rate cuts this year. Yet the market continues to price that in. Federal Reserve Chairman Jerome Powell also said that the management at Silicon Valley Bank failed badly while exposing customers to significant liquidity risk and interest rate risk. I'll get back to interest rates and inflation here in just a minute when we go over the questions. But he mentioned that my only interest is that we identify what went wrong here. And Fed Chairman Jerome Powell also said that rate setting committee considered a pause in rates for this meeting in light of the banking crisis. He says, and I quote, "We did consider that in the days running up to the meeting, but considering the higher than expected numbers coming in from labor market and inflation that came in stronger than expected, once again, recalibrated us to a 25 basis point hike." Once again, he says that we are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we will bring down inflation back down to 2% over time. It is important that we sustain the confidence with our actions as well as our words. And he warned the central bank still has some distance to cover as it tries to bring down inflation over the longer run goal. And the process of getting inflation back down to 2% is a long way to go and is still likely to be bumpy. And finally, inflation has moderated somewhat since the middle of last year, but the strength in these recent readings indicate that the inflation pressures continue to run high. So this right here was some of the questions that I was definitely looking forward to getting some answers on. So rate hikes, so we already got 25 basis points. In terms of rate guidance, they are expecting at the end of this year to be at 5.1% and then dropping that down to 4.6%. So if you come over to the SEP, actually 4.3% is that number by the end of next year. 5.1% is where we're supposed to be by the end of this year. And even in that range, you'll notice that 4.9 to 5.9% is that range. So they are willing to raise rates all the way up to almost 6% if needed, if inflation doesn't cool off fast enough. Inflation expectations, again, we already heard from Jay Powell himself. They still have a long way to go, and they are expecting inflation to come down to its longer run average, but it's going to take a lot of work for it to come down. And that being said, they are, seeing some moderation in inflation overall, but the last couple of readings, as he mentioned, has come in a little bit higher than what the expectations were. Employment-wise, they're still expecting, a very tight labor market. Jerome Powell mentioned that 315,000 has been the average job gains on a monthly basis over the last 3 months. So labor market continues to be very, very resilient, very tight. And then when it comes to how to contain the banking crisis, again, he mentioned that there is going to be the full support of the Federal Reserve government. They're providing bridge loans to the FDIC. They're backed by FDIC, so there's no risk for the Federal Reserve there. But then also talking about the investigation being led by other members of the Federal Reserve to figure out, what happened, why it happened, and of course, talking about Silicon Valley Bank and how their management failed miserably to hedge their risk and to pretty much account for the interest rate risk as well. And then again, finally restoring some confidence in among Americans to make sure that they know that their deposits are actually safe. Not explicitly saying that they're insured, but just saying that they are safe and we have the tools to use them when necessary. Now, bank term funding program, we didn't quite get into that too much. I think I saw one mention of this program once. And that's about it. This was a new program, and there was a question asked why use this program and why not the discount window. And Federal Reserve said that this gives us more flexibility and it gives more options to the borrower when it comes to borrowing and kind of making sure that they are well capitalized and liquid. He did mention that they are going to be doing it par, but nobody kind of stressed on that. I wanted to know more about why at face value. I mean, it's not a big deal, but definitely something that I wanted to get more insight on. No mention of the USD swap lines with respect to other central banks, so no questions were asked, and also nothing Jerome Powell mentioned around those things. And I mean, he did mention that over the weekend, they've been in touch with the Swiss government and the Swiss finance, committee, and they've been kind of working in support of that, but they didn't really talk about the USD swap lines because this was tapped out in 07-08. If you go back, this was tapped out at over $580 billion, right? Because there was a lot of banks around the world going through pretty much a seizure in liquidity. There was a lot of capital, breakage. So we didn't really go over that in too much detail, and I would have liked to learn more about this. In terms of the Fed's balance sheet, again, very briefly, we went over that. They're still committed to reducing the size of the balance sheet, but with respect to the loans that they're providing, that's obviously putting total assets back higher by almost $300 billion. Nobody really stressed Jerome Powell too much on that. Again, there were a couple of questions with regards to this, but he pretty much mentioned that these are only lending activities to make sure the banks have the liquidity that they need in order to capitalize well and, of course, make sure that their deposits are safe. And the overall tone, I would say, was very neutral. I wouldn't necessarily call this meeting hawkish. I wouldn't necessarily call this meeting dovish either. It was very neutral because we did get some dovish pieces, which was the statement change. No more additional rate hikes. Instead, we're moving towards some additional firming. That's a big change in the guidance, and 25 base points, and then another 25 base points, and then there's absolute pause expected. But in terms of when you look at the hawkish stuff, he mentioned that there's not going to be any rate cuts. Inflation's going to still be a little too, challenging to bring down. It's gonna be a long way to go, and we can and will raise rates if necessary. So those were some of the hawkish points from Federal Reserve, from Jerome Powell. So let me know your thoughts down in the comment section below. I've already mentioned, I think the market's pricing in about 7 to 8 rate cuts. Need to tread very carefully because Jerome Powell has literally mentioned that there's not going to be any rate cuts this year. Now that doesn't mean that it can't change. It can certainly change in the future. It absolutely can change if inflation drops dead pretty quickly, but the market is still very much anticipating quite a few rate cuts later this year and next year, which Jerome Powell has not given us the green light for. So let me know in the comment section below, what do you think about the entire speech, and how are you positioning yourself? Would love to know from you down in the comment section below. So always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining us. As always, happy investing. I'll see you all in the next video.